All right, let's go through the key macro stories this week and take a look at what they actually mean for you and the markets. Markets are coming into this week trading near all-time highs, but the overall tone feels more cautious than the price action alone would suggest. Volatility remains relatively low, and risk appetite is still present, but positioning looks careful. This is one of those weeks where the economic calendar appears fairly light, yet markets remain vulnerable to sudden shifts driven by headlines or changes in expectations. The main focus this week is the Federal Reserve. The rate decision itself is widely expected to be a non-event, with policy rates almost certainly remaining unchanged. What really matters is the communication. Markets are listening closely to how the Fed frames the outlook from here, and whether policymakers sound comfortable with current conditions or emphasize the need for continued restraint. Here you can see how rate expectations have evolved over recent weeks. Markets have largely moved away from the idea of aggressive near-term rate cuts. Instead, the baseline view has shifted toward patience. This meeting is important because it will either confirm that shift or introduce doubt about how long rates might stay restrictive. Small changes in language around inflation or the labor market could have an outsized impact on expectations. One complicating factor is the data backdrop. The Fed is heading into this meeting with less clarity than usual. Several key economic reports were delayed, and others arrived later than normal. As a result, policymakers are making decisions with an incomplete picture of current conditions. When the most recent labor market data finally came out, it showed a clear slowdown in hiring. Job growth has cooled, and job openings have declined from previous levels, suggesting that demand for labor is easing after a long period of strength. At the same time, there are still no obvious signs of stress. Weekly jobless claims remain low, and unemployment is relatively stable. This looks like moderation rather than deterioration, which gives the Fed room to remain patient. The bond market reinforces that message. Here you can see that Treasury yields remain elevated across the curve. That suggests investors are not positioning for a rapid pivot toward easier policy. Financial conditions remain tight, even as equities continue to trade near all-time highs. This combination supports risk assets for now, but it also increases sensitivity to any negative surprises in growth or inflation data. Inflation remains a central theme this week. Producer price data later in the week will be closely watched for signs of renewed pressure. Inflation has come down significantly from its peaks, but the final stretch lower has proven difficult. Services inflation remains sticky, and the economy continues to show resilience. If inflation data surprises to the upside, it would complicate the case for rate cuts and push expectations further out. Softer data, on the other hand, would support the idea that disinflation is still progressing, even if slowly. On the equity side, the market continues to hold firm. Here you can see that stocks are trading near all-time highs, but sentiment does not appear overly stretched. Volatility remains subdued, and sector performance suggests selective positioning rather than broad-based risk-taking. This is consistent with a market that is optimistic, but still aware of the underlying risks. Commodities are also sending interesting signals. Here you can see the strength in precious metals, which often reflects uncertainty around inflation, policy, or broader macro risks. Energy markets have also started to show signs of life after weakness toward the end of last year, adding another layer to the inflation and growth discussion. Stepping back, this week feels more about confirmation than resolution. Markets are watching how the Fed characterizes inflation and labor conditions, whether incoming data supports the soft landing narrative, and how investors respond to that information. Often, the market reaction itself is more informative than the data point. The broader picture hasn't changed dramatically. The economy is slowing, but it remains resilient. Inflation has eased, but it hasn't fully cooperated. The Fed is trying to balance patience with flexibility, and markets are adjusting to that reality. In this environment, adaptability matters more than strong conviction. Let the data come in, watch how expectations evolve, and be ready to adjust if the narrative shifts. If you find these macro updates helpful, you can support the channel by liking the video. And if you want to keep getting more of these, feel free to subscribe. Drop your thoughts in the comments. I read them, and they're often more insightful than the headlines. Thanks for watching. I'll see you in the next one.